Well, howdy folks, and welcome to yet another edition of Smarter Money Matters. It really does, with your wealth Dr. Jeff Camarda, joined by super CFPs Lou and Anna. And today we're going to focus on, there's a lot of changes going on in the global economy, as we mentioned in a recent podcast. And interest rates are going up, spiked by inflation, I think, and what's happening with the war in the Middle East. So this is a recent Wall Street Journal article called The Global Bond Rout and What It Means for Your Money, Markets, and the Future. So let's get in. Obviously, you're joined by Jeff. I'm the macro strategist and chief wealth educator. Anna is a curious analyst connecting ideas to everyday investors. And old Lou, practical market veteran, risk-focused commentator. Would you say that's reasonably accurate, folks?
Sounds fancy, yeah.
All right, well, welcome back to the show, everybody. Today we're diving into something that sounds technical, but can really impact literally every investor that's watching this, homeowner, retiree, or business owner listening right now, the accelerating global bond rout. Now, I know bonds don't exactly sound that exciting or sexy, but when bond markets move violently, everything else starts shifting too. Mortgages, stocks, business borrowing, even the economy itself. And according to this recent article, the global bond market sell-off is intensifying, and what that means is when interest rates go up, the value of bonds goes down. With U.S. Treasury yields surging towards levels we haven't seen in years, maybe decades. I think the 10-year is up around 5% last time I looked. So today we're going to unpack why bond yields are suddenly spiking, what war and inflation fears have to do with it, why investors are having flashbacks to 2022, which, as you may remember, was a pretty nasty little bear market, and what this means for stocks and retirement portfolios, and most importantly, what smart investors should do now. Anna, Lou, great once again to have you here, and let's turn it over to Anna.
Yeah, Jeff, thanks. I think this topic is incredibly important because most people don't realize the bond market is really the foundation underneath the entire financial system.
Lou?
Yeah, exactly. I mean, people watch the Dow every day, but the bond market is where the real pricing of money happens. And when bonds start to break down, borrowing costs rise significantly.
So what's really happening? Let's start with the headline first. The article says the 10-year Treasury yield climbing at 4.7%, with a 30-year Treasury moving above 5.2%, which is almost a 20-year high. Now remember, when yields rise sharply, bond prices fall sharply. And the sell-off isn't isolated to the U.S., it's global, it's happening around the world. Anna, would you explain why this matters to these folks?
Yeah, so government bonds are considered the risk-free benchmark of the financial world. Everything else is priced off of them. Things like mortgages, business loans, credit cards, corporate debt, and even stock valuations. So when those treasury yields jump, the cost of money rises across the entire economy. And the article points out that this is happening during a period where stock markets have been rallying hard. Especially tech stocks tied to the AI boom.
Some would say, way inflated bubble territory bound to burst, and this could be fuel on the bubble fire. Lou?
Yeah, and that's important because rising yields eventually compete with stocks.
So say that again, would you please?
Sure. And that's important because rising yields eventually compete with stocks. If investors can suddenly earn 5% of government bonds, they start saying, why am I taking stock market risk? And then pricing, that pricing process can create real pressure on equities.
So some investors say, gee whiz, I'm hoping to get a 5% dividend yield, maybe a little appreciation of stock, and if I can get that much on a safer investment like bonds, maybe I sell my stocks and buy bonds, right?
Exactly, yeah.
So exactly, this is where people often misunderstand the market. Stocks don't exist in a vacuum. The price investors are willing to pay depends heavily on interest rates. When rates rise, future profits become less valuable. Borrowing becomes much more expensive, corporate growth slows, consumers spend less. That's why the bond market matters so much. So let's, kind of seg into the war factor here. The article says one major catalyst now is the U.S.-Iran conflict, which really shows no signs of abating at this point, and disruptions around the Strait of Hormuz. Lou, would you explain the connection between geopolitics and bond yields?
Sure. So energy, for example, the Strait of Hormuz is one of the world's most critical oil shipping routes. And if conflict disrupts oil flow, oil prices spike. And when energy prices rise sharply, transportation costs rise, manufacturing costs rise, consumer prices rise, and that creates inflation pressures.
Yeah, and suddenly the market starts thinking the Federal Reserve may not cut rates after all. The article says that investors have dramatically shifted expectations, moving from expecting rate cuts this year to potentially rate hikes. And that's a huge psychological shift.
Exactly. Markets are forward-looking machines. If investors believe inflation may re-accelerate because of energy costs, they demand higher yields immediately. And remember, bond investors hate inflation because inflation destroys the purchasing power of fixed investments. Lou?
Yeah, which is why yields can spike violently during inflation scares.
So yields can go up dramatically when people are scared about inflation. Is that right?
Absolutely, yeah.
And bond investors, what are they saying?
Well, if inflation's going higher, you need to pay me more, to lend you money.
That's exactly right. People don't realize that bonds, if I buy a bond, I'm lending money to the issuer of the bond. That's a transaction. That's why they call it debt. So one of the most fascinating parts of this article is a psychological component. The article quotes a JP Morgan portfolio manager saying investors now have PTSD from 2022, post-traumatic stress disorder, right? So Anna, what does that really mean?
Yeah, so 2022 shattered assumptions, right? For years, investors believed inflation was temporary, rates would stay low forever, central banks would always come in and rescue markets. And then suddenly, inflation exploded, the Fed hiked rates aggressively, and then both stocks and bonds fell together. That was shocking because traditionally bonds in a portfolio were supposed to cushion stock declines.
But not always, right, Lou?
Yeah, instead, in 2022, that became one of the worst bond years in modern history. And institutional investors still remember that pain. So now, whenever inflation fears reappear, bond traders react much faster and much more aggressively.
Well, that's kind of getting for both barrels. It's such an important point. Markets are emotional systems. No matter what the colored graphs and numbers say, they're run by people, and people are wacky, crazy, emotional, right? Recent trauma changes investor behavior. It's called recency bias. And what we're seeing now may partly reflect fear that the Fed could again be behind the curve. So let's talk about some of the global fiscal worries. Now that we move into another issue, as mentioned, what's happening around the world. The piece mentions rising yields not only in the U.S., also in Japan. Like Japan is selling, treasuries buying Japanese bonds. By that hasn't happened since I was in high school, I don't think. But also in Japan and the United Kingdom. Lou, why are investors suddenly so violently worried about government debt levels again?
Yeah, because governments around the world, worldwide, are borrowing enormous amounts of money. And investors are starting to ask how much debt is too much. How much is too much? And when supply of bonds explodes, governments must attract buyers. Buyers demand higher yields, and then financial cost rises further. So it becomes a dangerous, vicious cycle.
Yeah, and I got to tell you, who've been working on the podcast, government debt levels are like crazy high. The U.S. government now owes more money than it did after paying for World War II. Let that sink in. Let that sink in, the enormous cost, and there's no end in sight. It looks like it's going to keep going up, 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 and up, and up. Anna?
Yeah, so the article specifically mentions fears that the world is becoming swamped with bonds, and that's powerful language. It matters because if governments must constantly issue more debt to fund spending, investors may require higher compensation indefinitely. Which
is why which has enormous long-term implications. For decades, investors benefit from falling interest rates. Like since, I don't know, when did the rates spike? In 1982, something like that? I was just getting out of college. That boosted stock valuations, bond prices, real estate values, private equity, venture capital. Interest rates went down, all the rest of the stuff went up. But if we're at an inflection point, if things are starting to go the other way, if we enter a structurally higher rate environment, asset pricing models may fundamentally change for a long time. These things, when they change, like I said, interest rates went up to about 81 or 82. And how long has that been? Help me with the math. 45, 47 years, something like that, maybe a little long. So what does this mean for stocks? The article notes that the S&P 500 recently fell about 2% over 3 trading days, while NASDAQ also weakened. And why are higher yields, and that was just kind of a gut punch, it's really just kind of an emotional reaction, I think it's getting worse, but Anna, why are higher rates particularly dangerous for growth stocks?
So growth stocks, like a lot of technology stocks, depend heavily on future earnings. When interest rates rise, those future earnings get discounted away more aggressively. That hurts valuations. It's especially problematic for tech companies, AI-related stocks, speculative growth companies, which, these investors in those companies were paying very high multiples based on, optimistic future growth.
Yeah, that's a very important point. There's another factor too, though.
Yeah, and that other factor is higher real yield. So, article points out that TIPS, inflation-adjusted bonds yields, which are inflation-adjusted, like you said, have been rising too. And that's important because rising real yields often pressure stocks even more than rising nominal yields.
Exactly. If inflation rises but real yields stay low, stocks sometimes tolerate it. But when real borrowing costs rise, companies are having to pay more in their bonds and pay more interest, to fund their expansion. That tightens financial conditions really, really fast. And historically, that can eventually slow down economic growth. So what should investors do now? Let's get practical. What should investors actually do in an environment like this? Lou, why don't you start us off?
Yeah, absolutely. So first thing to look for is to avoid emotional reactions. Bond volatility doesn't automatically mean a catastrophe, but investors do need to reassess risk exposure, especially, if they're exposed to long duration bonds, speculative growth stocks like Anna was pointing out earlier, and then over-leveraged investments as well.
Yeah, I'd also add diversification is important. Periods like this remind us diversification matters. Things like value stocks, cash reserves, money markets, shorter duration fixed income, and targeting quality business with strong cash flow. These areas often will hold up better when rates rise.
And I'd also add tax strategy, my favorite topic, and cash flow planning become even more important. Higher rate environments punish inefficiency. Families carrying unnecessary debt, expensive taxes, concentrated risk, illiquid investments can suddenly feel enormous, maybe back-breaking pressure. This is why holistic wealth planning matters so very much.
Yeah, and investors need to remember, markets reprice faster than economies, and sometimes markets panic before fundamentals fully deteriorate. So discipline matters.
And context matters too. The article actually points out one positive interpretation. Higher yields may partially reflect confidence in economic strength. Strong employment data and resilient consumers can also push yields upward. So this isn't necessarily an immediate recession signal.
But it certainly is a gut check to make sure. It's a great point. The challenge really separating healthy economic strength from destabilizing inflation pressure. And again, put that on top of the transformation of AI, crazy valuation. SpaceX is about to come out of it, or has come out. When you see this, the fact that people, the job market is shifting, inflation is spiking. There's a lot of things going on that they're really complicated. And markets are really wrestling with these questions in real time. So final round, rapid fire takeaways, one sentence each. What's the biggest takeaway a listener should remember, Anna?
Yeah, I would say, bond markets drive the cost of money. And when yields rise fast, every single asset class has an impact.
How about Lou? What's your takeaway?
Yeah, the world may be entering a structurally higher rate era, and investors need to adapt instead of assuming that the last 15 years will repeat.
And mine is the environment really rewards disciplined, tax-efficient, risk-aware investors, not crazy speculation. So, one thing that I'd like to kind of add is this is really important, particularly for non-Camarda clients that, most advisors, are kind of wedded to the, I think, outmoded, if it was ever even accurate, textbook portfolio, 60-40 in stocks or 50-50, whatever, and the rest in bonds. And you got to remember, it's conditions like this where you have overvalued stocks and arguably overvalued bonds could risk a double whammy. But usually these are combined because when one goes up, the other one goes down. And in many periods that's happened. but when you get the right mixture of factors, it can blow up in your face. You have to be careful. Anyway, on that cheery note, thanks everybody for joining us. If you enjoyed the conversation, please share it with somebody trying to make sense of today's markets and uncertainty. And remember, wealth isn't built by reacting emotionally to headlines. It's built by understanding the forces underneath them. We'll see you next time. Thank you so much. Once again, super CFPs, asthmatic Anna, hopefully only briefly, and Lou, and of course me, Jeff Camarda. Bye-bye, guys.